You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo.
Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. I hope you are doing well on this Monday. To have fun today, I want to look at the bull case for BCE. I've been hard on this one big time over the past 2 years. We downgraded it at Dividend Stocks Rock in 2023 at the beginning of the year. We downgraded it again not too long ago, and I'm trying to see if there's a bull case. Total return year to date is about minus 22. That included dividend, unfortunately. Total return over the past 5 years is minus 18. So again, including the dividend. And total return over the past 10 years, 27%. So investing in GICs, in a GIC ladder over the past 10 years would have generated probably more return than BCE. So is there any hope for this one? Can we find the light at the end of the tunnel? I know that you have appreciated my bear case for my favorite stocks. So today we're trying to do the opposite and try to make a bull case for a stock that I don't really like and I would not invest money in. All right, so let's start with something a little bit obvious, but that could continue to grow a long way. Very strong network, wireline and wireless. Most importantly, fiber to house network. That type of internet technology is amazing. This is what I use at home. It's very stable. I'm able also to do those webinars with like super high speed. So I cannot tell more about this. I mean, it's going well. They have an impressive network across Canada. They can scale this. They can benefit from economies of scale. And there's also a link to the Ziply acquisition, of course, because Ziply is offering a similar service in the U.S., on the Pacific Northwest, into 4 states. They have like more than one. I think it's like 1.3 million clients. Bell said that they expect to grow even more, like to up to 3 million in the next few years. So definitely opening the door to the U.S. is a good idea. I know it's great we have an oligopoly in Canada, but the oligopoly, as much as it protects the business, it's also slows down a little bit your growth potential. So the big guys, Rogers, TELUS, Bell, they're all fighting for the same pie. And then you have like smaller players like Quebecor that bought Freedom Mobile in the Shaw-Roger merger that increased competition in the wireless. So going south and into internet fiber, which makes kind of sense for them, for Bell. So I get the idea of like opening that door. And yes, they could scale even more because it's a technology that they know, they use, they have strong expertise. And as management said, it is like the deal is supposed to be accretive and start generating cash flow right up front and more profit. So when you combine the strong fiber network and the acquisition of Ziply, we're starting to have a beginning of a bull case here, but unfortunately, that's about the end. The thing is, while I was researching and I was trying to find positive things to say about Bell, I came across a lot of investors saying, because this is what I do, like, when I like a stock, I try to see the opposite. So to counter my bias, I don't want to go with like confirmation bias or just find people that to say the same thing as me. So I'm trying to see the other side of the coin. So when I'm about to buy a company that I like, I just read articles that are negative about this business to see how it goes and say, well, maybe, okay, that's a fair point. I have to consider this risk. For Bell, I did the opposite. I was trying to find arguments for BCE. And one argument that kept coming back was interest rates are getting cut, it's getting lowered, so it's going to help telcos and other capital-intensive businesses. So there was like a large argument where, well, if interest rate are going down, it's good for the business. They won't have any debt problem anymore. Well, that would be almost true if you were on variable rate. So when I look at my home equity line of credit, the interest rate goes down. The next morning, I pay less interest. I'm super happy. But when you are on fixed debt, the fixed debt, which is the case for BCE, by the way, the fixed debt doesn't move as fast as variable because it's not linked to the Bank of Canada overnight rate, but it's rather based on the bond market and the spread in terms of risk between the government bonds and the corporate bonds, and then the value, the classification you have for your bonds. So Bell right now has been downgraded by Moody's a few months ago, so it's not helping. And they have about $7 billion up to renew, a little bit more than $7 billion in the next 12 months to renew, and a big chunk is already at a lower rate right now than they will when it comes to maturity. So interest charges, long story short, interest charges will continue to rise in 2025. This is a false bull case here about the interest rate cuts. It's, yes, for the long run, it may help Bell, but in the meantime, they already said, well, we sold our stake in MLSE to pay off debt, which was kind of like a good thing actually to do. But then 7 weeks later, they said, well, we're actually going to take $4.5 billion proceeds that we're going to receive from Rogers, and then we're going to spend $7 billion into the Ziply acquisition. So if you're making the quick calculation, 7 minus 4.5, you're kind of short. So that means more billions into debt in 25, and the interest charges will continue to rise. So we saw that in the latest quarter. I think it was up like 17 or 18% versus last year. It's going to continue this way. Interest rate cuts is not going to save BCE for this year. Another thing that could have saved BCE, and that could make sense, would be demographic. The more people we are in Canada, the more like the people that will use internet and cell phone and data, because I mean, it's like number one service, right? Yeah, like a lot of people cannot live with their phone, and that makes sense. The thing is, we don't have a strong natality rate in Canada, so people are not making that many kids. I'm contributing pretty much here with 3 kids. I'm trying to help Bell here, but I guess it's not enough. And we have a cap on immigration now, so lower immigration going forward. So that's not going to help either. So while overall the demographic case would have helped Bell, it's not going to happen in 25 either. So now we have the interest that is not going to happen, the demographic that is not going to happen. And one thing that bugs me a lot is for Ziply to work, it will require more investment. You know, yesterday, like Friday, I discussed about CapEx and investing in the business to make it grow. Well, Ziply acquisition is this type of business as well. They will require more capital to grow. Right now, BCE does not have enough free cash flow to pay off all their stuff that are on their balance sheet already. So more money towards Ziply to grow means more debt. Long story short, I'm not able to make a bull case about BCE unless BCE cuts its dividend. Because I know, I just said that. I just said like the C word, like dividend cut. In 2025, BCE will pay almost $4 billion in dividend. That's a lot of cash flow that could be redirected to boost Ziply, to pay off debt, and to like find growth vectors for Bell. They said they would freeze their dividend growth, so they're not going to increase in 25. But really, if they want to survive and eventually thrive again and go back into growth mode and show cash flow generation that is positive and better revenue and better earnings, they must cut their dividend. Like that's the ultimate way to actually liberate. Like imagine if they slash the dividend by 50%, that's almost $2 billion in cash that now they can reinvest in the business instead of like just dripping this away from the bank account. I don't know about you, but it seems to me that it would be a very smart move to make. And that would almost make me bullish. I'm not gonna buy Bell. I don't think so because I have like a lot of problems with how management improvise right now. But if they cut their dividend by $2 billion, I would be willing to revisit the stock and be interested again. In the meantime, I really don't see how it's going to grow over the next few years. So best case scenario, it's going to go back to growth in like 5 years, and you're going to have like a very long path through hell in the meantime. In my opinion, it sounds like there's a dividend cut in the making. The market seems to price it. The numbers are telling me the same thing. And when I look at the business and I'm thinking about how can I make this business grow and be amazing again, I see the dividend cut as like the number one thing on my list. So sorry guys, I really tried to have a bull case on this one. It's not happening, but I'm open to discussion. So let's meet on YouTube. Let me know about your bull case. Let me know about how the business will make that happen instead of just going say, oh, everything's gonna be all right. That's a good song, but it's not good enough on the financial statements. All right, Moose, have yourself a great day, and we're gonna talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.